It's just the background. A very good evening to you all, friends. I am Sanjeev Singhal, Chairman of the Sustainability Reporting Standard Board and the Auditing and Assurance Board. I welcome you to the 21st program of the Auditing Standard Board for this council year. So far, we have done 20 programs. Now, out of these 21 programs, 17 were on bank audits, and the bank audit season is over now. And with the season for the statutory audits. So this is the fourth webinar on the auditing standard, and over a period of time, over a period of 45 days, we plan to cover all the auditing standard with various experts. So today's topic is auditor's responsibility relating to fraud in audit of financial statements, so covering SA 240, and communication with those charged with governance and related parties, covering SA 260 revised and SA 550. And friends, today the importance of these topics cannot be overemphasized. We all know that, there's a term that we use, expectations gap. So there are different expectations of different stakeholders. There is the shareholders who expect an auditor to be diligent, to express a true and fair view on the financial statement. Then at the same time, there are expectations of the lenders, there are expectation of the government, expectation of the society. And over a period of time, what we have seen is that these expectations from the auditing profession have increased. The society expects, the government expects that an auditor will protect the interest of everyone, and bring out the deviations in a sharper manner. So this SA 240 talks about auditors' responsibility relating to fraud in audit of financial statement, and this you should also read along with the revised CARO on which you are going to report, because CARO casts specific responsibility with respect to reporting of the frauds, and with an added clause on the whistleblower complaints. So an auditor is also required to examine the whistleblower complaint and see what's been the outcome of those whistleblower complaints. And of course, the another topic that we have, communication with those charged with governance. So naturally, this is a communication which the auditor does with the top management or the people in charge with the governance of the affairs of the company. So what should be the contents of that communication? So this auditing standard talks about that, and what's the auditor's responsibility. And of course, on the related parties, that's always been a very, very important standard, and there are practical issues also in the implementation, because when there are transactions with the related party, they need to be scrutinized more. But at times you don't get an arm's length price if the related party is a sole supplier of those goods or services. Then establishment of the arm's length price becomes difficult. And then there are circumstances where, say, for technology, a consolidated charge is made by the parent. So these kind of related party transaction do pose a very important challenge to the auditor. So we have this framework which is available, which is sufficiently detailed and has been established over a period of time. And these are in line with the international standards. Though we expect that in the times to come, some of these auditing standards will evolve, will change. The Institute of Chartered Accountant of India, we are also doing a project on expectation gap. There is a paper of the IAASB which talks about the expectation gap, and which says that the expectation gap can be classified into three categories. One is a knowledge gap, second is a performance gap, and third is an evolution gap. So knowledge gap basically talks about the knowledge of the people who are responsible for conducting an audit. And a performance gap is the actual performance of the audit. And an evolution gap is basically the regulatory gap which emerges, or the regulatory development which emerges over a period of time in the form of changes in the auditing standard or changes in the law. One such piece is before us, the CLC report, the Corporate Law Committee report, which has been issued by the Ministry of Corporate Affairs, on which the comments are due by 6th of May. And it talks about a number of things. It talks about non-audit services. It talks about the joint audit. It talks about standardization of qualification. It talks about the SS 600, that is the parent company auditor should independently also verify the subsidiary company accounts. And it also talks about the resignation by the auditor, apart from various other topics on the ease of doing business. So So it's an evolution, it's a continuing process. And at the Auditing and Assurance Standard Board also, we are aware of these changes which are taking place. And that is why it's our endeavor that on the knowledge gap, we are doing these webinars to bridge that knowledge gap. Performance gap, friends, we expect all of you that with the help of these webinars and then with the help of the other tools which are available from the Institute of Chartered Accountant of India, other technical publications, and say the publication on the commonly observed error, etc., this performance gap will be reduced. And evolution gap, we are well aware of the evolution gap and taking care to plug it and to ensure that it is compliant with the international auditing standards at all points of time to the extent possible. I mean, to the extent possible, when I say as a country, whatever we decide that this is the thought process, this is how we have to do. So AASB and the institute is always keeping itself updated. And I would like to express my sincere thanks to both the speakers today, Shri CA Ashish Gupta and CA Suman Chadda. Suman Chadda ji is also a special invitee of our Auditing and Assurance Standard Board. And so both are very renowned auditors and very competent professionals. So I'm sure that they will guide our members. And I'm also thankful to my senior council colleague, CA Ranjit Agarwal ji, who is now the chairman of the Committee for Member in Industry and Business and is leading a very, very successful campus placement for our members. And this time, members will be happy to know that we had around 11,000 vacancies and 9,500 applicants were there. So kudos to him. And earlier, he's been the chairman of the Ethical Standard Board. He's been a chairman of the Tax Audit Quality Reporting Review Board and many other flagship committees of the institute. And I've seen him working very, very closely. We also call him father of UDIN. He was the one who brought UDIN for the members and which is running so successfully now. And I really admire him for the sheer passion and commitment that he has for the profession. And I requested him to be a keynote speaker today for a few minutes on the importance of the topic and importance of the auditing standards in general. I'm thankful to him that he has agreed, and I would request him to deliver his keynote address. And followed by that, we'll be requesting the two speakers to deliberate on the topic for the day. Thank you, and over to you, Ranjit Bhai.
Thank you, Sanjeev Bhai, chairman of this AASB, very important committee. I must compliment you and Vice Chairman Vishal Doshi for bringing out this series of the essay on various discussion on the various essay through webinar. And I think this is the need of the hour, where so many expectations are from the stakeholder and how far we are living up to that expectation. So the knowledge of the standards, what is the inherent in the various standards, most of them are aware, but at the same time, when we discuss with the speaker like Suman Chadda ji and Ashish Gupta ji, so our knowledge also widen and we also take a call what to do. If you see all these three standards, very nicely they have related all these three standards. SA 240 talks about auditor's responsibility relating to fraud. Then this SA 260 talks about this communication with those charged with the governance or management, and then the related party. So all the three standards are related in many ways. If you go through the maximum standards or the CARO or the Companies Act, all three elements are common in most of the places. If you talk about this SA 240, many inherent parameters has been inbuilt into the standard itself, through which we can detect the fraud or we can take a conclusion, like abrupt verification of inventory at various level. That can be the process of verification of the inventory. Analyzing the journal entry, that is also one of the process. Counting or cash or securities at the near year end or any other time. It's a direct confirmation with the party. It's all the analyzing the return of accounts. This is also very important part if you analyze. Then analyzing the shortages, inventory shortage, other shortage. One more important point which I have noticed in the standard, if you analyze the sales return and discount, you will, if you find the unusual trends and the pattern, that is also a very, very key factor to make a report. And when you also deal with the third party, what are the specific terms in those agreement with the third party. Also, these are very, very important. And I personally believe when you go through these standards, a very important thing that if you verify the newly purchased fixed assets, physical verification of the newly purchased fixed asset, also very, very important trigger point can be for the auditor. These are the some of the examples which we can look into while going through these standards. And the most important part, which I feel in the fraud, that SA 330. SA 330 also, which Sanjeev Bhai will also deliberate some point of time. It also talk about the audit process performed and the audit evidence obtained. Now we have to evaluate whether the assessment of the risk of material misstatement at the assertion of this level, various level, are appropriate or not. So SA 330 also play big role while dealing with the fraud. And entire standard I have seen that talks about the you cannot take a call that there is a fraud, and at the same time you can say there is not a fraud. So you have to be very balanced approach while dealing with the SSC or auditee, and the professional skepticism. This is a very important point in all this entire SA 240. But if you see the new Caro, as rightly said by Sanjeev Bhai, new Caro, they are change a huge requirement in this new Caro. If you go through the new Caro 2020, you will find how much more reporting, you have to do while reporting on the Caro 2020. Earlier, there was used to be the reporting on fraud committed by only officer and employee. Now they are saying committed by company on or company by anybody, not only by employee or officer, anybody on company or by company, they have said. In this fraud reporting, I have my personal view that we have a very beautiful publication by the ICI in the form of guidance note on section 143.12. It's a very beautiful document published by the ICI as far as fraud reporting is concerned. And in this new Caro, when they talk about whether you have we have to report on unrecorded transactions, whistleblower complaints, we have to also now report on the evergreening of loans and advances, whether loan given, taken, again given, taken, like this evergreening of loan and advances, willful defaulter. Now it's a very subjective term. So what can be willful defaulter? ICI has also guidance note on willful defaulter. So please go through that guidance note to know whether willful defaulter, who can be the willful defaulter, what will be the purpose of utilization of the fund, short term, long term, we also know. But if you go through this 143.12, 447 of the Companies Act, SA 240, new Caro, all these things that it talks about how we can detect the fraud and report the fraud. But one more important aspects while dealing with this, now a resignation of auditor. Clause 8, Part 1, Schedule 1 talks about when you have resigned, an incoming auditor has come in. And if the incoming auditor asks you to please tell me if some non-compliance is there in this company, and if you as a outgoing auditor are aware that some non-compliance were there, and you has been asked by the incoming auditor, then it is the duty of the outgoing auditor to provide these details to the incoming auditor. So it's a very important paragraph added in our new code of ethics as far as resignation is concerned. So when you talk about the non-compliance, and if you go through the entire audit process, you cannot afford to miss whether there is a compliance or non-compliance. So all these aspects you have to deal with while dealing with this fraud reporting. And if you talk about this as rightly said, new report of the company law committee, the first line of this new report, which I am find very interesting, which says that auditing is an independent review of company's financial statement by the auditor. Fine. It is essential in detecting and preventing errors and fraud. It is essential in detecting and preventing errors and fraud. So that is the expectation of the stakeholder from the auditor. in this new company bill or other caro and other things. So we have to think 1947 or otherwise all these standards we have framed. Auditor is a washed over bloodhound, and now we have to redefine our role. We have to be forensic auditor. All these things we have to threadbare double ASB dealing so many issues in this regard. And I think this interaction on the webinar will be very, very helpful in the role of the auditor, whether we have to redefine or we have to go by the traditional way which we are doing. As far as this SA 260, communication with those charged with the governance is concerned, one of the major para I have seen in this standard that auditors' independence. An ethical issue, ethical standard board also talks about the auditor has to communicate with the management or those charged with the government that I am independent. So what is your criteria of fees for the audit service or non-audit service? All this clarity has to be given by the auditor while dealing with those charged with the governance. But the one more interesting aspect I would like to discuss in this SA 260 is the NOCLAR. Now, non-compliance with the laws and regulation is already implemented by the ICI. It has been deferred for the time being. But now, if you find some non-compliance of the various other law, not only the financial law, other law, you have to communicate with those charged with the governance. So communication with the management or those charged with the governance is equally very, very important. How to communicate, when to communicate, that is the professional skepticism guided by the accounting and auditing standard of the ICI. As far as this SA 550 related party is concerned, there was a stigma that related party transaction is there, something wrong is there. It's not like that. Related party transaction is bound to happen. The kind of economical world we are living, holding subsidiary, associate company, all these things. So related party transactions are bound to happen. Our role is whether it has been identified whether the related parties are there or not, and has to be reported properly. That is the role of the auditor as far as the SA 550. We have SA 18, SA 315, 330. All these standards are there, which talks about the related party transactions. And I see how you can find out the related party exists or not, or transactions are there or not. There are so many mechanisms. Reports are there, minutes are there, third party confirmation, register of investments are there, LIC policy of the key management personnel are there, contract with the management, purchase vendor list, all these things are there. How we can find out related party exists or not, or how many transactions with them are reported properly or not. I think these are the important highlights of these three standards. I'm hopeful that all these two speakers will threadbare, deliberate in all these aspects, and will be enriching experience to all the members who are watching this webinar. I must thank Sanjeev and all the vice chairman for nicely arranging all these three standards, and it will be a nicely enriching experience for all of you. Thank you very much.
Thank you so much, Ranjit Bhai. The kind of overview you gave for Caro and these standards is really, really very appreciable. And the Vice Chairman Vishal Bhai generally joins in the second section. I mean, when there are question and answers. And so I'm sure right now 1,700 plus members are there, and each webinar is attended by 2,400 plus. And I'm sure that as we progress, we'll have that kind of a number. And it really gives us satisfaction that if we organize, say, 25 webinars on various auditing standards, if these are attended by 65,000 members, then that really gives us satisfaction that our members are taking an interest. So thank you so much, Ranjit Bhai. And now I would, and I really thank you that you stuck to the technical points as a keynote speaker. And now I would request both the speakers to start their deliberation. I think Suman Chaddaji will start first. And as I said, that he's a special invitee to the Auditing and Assurance Standard Board. He's a partner with DR Chadda, and Ashish is a partner with Walker Jindyo, and both are very renowned speakers and the auditors. So over to you, Sumanji. Sumanji, you are on mute, it seems.
Thank you very much, C. Sanjeev ji and Ranjit ji for giving us an opportunity to be with our brothers and sisters, and on a time where we are in a watershed period for auditing profession. We have to reinvent ourselves and then again reinvent ourselves as we understand. Uh, Ultimately, everything is something related to auditing somebody else's accounts. And so it is basically like running with two legs. So both the strength and the length of the legs have to be in sync with each other so that one can run. If one leg is strong vis-a-vis the other one, or there is some kind of lack of coordination, we are bound to fall or leave behind. So understanding the culture, the tone, the sentiments of the organization, how they really function informally, formally. Equipped by the accounting standards, the auditing standards, the regulatory requirement, my personal training as a chartered accountant, and that of my teams, all have to come together and come into a very synchronized harmony to be able to perform an effective audit. And the bar has been being raised every time as we go along our journey, and we are all back to schools, learning, relearning. So this actually keeps us on our toes, literally. Today, there are two essays I'm going to talk about. First is those essay 260. So if I'm allowed to share my screen, I'll I think, is that visible now? Friends, is it visible?
Yes, sir. It's visible.
Yeah. So basically, the first is communication with those charged with governance. Primarily, I need to communicate. Now, communication in our normal parlance means a two-way talk. In my sense, it is more of listening than kind of giving information. But as far as the scope of SA 260 is concerned, it actually defines my responsibility as an auditor to communicate with those charged with governance when I'm auditing any financial statement. So what it does, it provides a framework, a bedrock of how such communication has to happen, how I have to identify the specific matters to be communicated, what are the timings of this communication, and what are the considerations I have to keep in mind as far as this communication is concerned. And who are those who can be considered as those charged with governance, what is the difference between the management and them? All that is very lucidly explained in this. There are other communication requirements by other essays, which I'll touch upon briefly at the end of my presentation on this one. And also there is a aligned communication through SA 265, which talks of deficiencies in internal control, which I'm not covering today. And this SA 260 also covers audit other than historical financial information when there is a merger or any specific purpose requirements, any stub period accounts, and so many other exigencies which require actually reporting to the government, to the governance structure. Now, what most of the organizations which we audit are not large, not very formally structured. Many may not have an audit committee, but still this standard applies. Many people have this bhram, I may say, that if the audit is not of a listed company, large company, then this SA 260 has to be diluted. It loses its meaning because anyway, I am in touch with the management on a day-to-day basis, one MD or one CFO, and that's how the audits are carried out. But somehow there is a big gap and a difference between that and what this standards actually, this accounting auditing standard actually requires. As I earlier mentioned, effective two-way communication is there. We have to understand matters which are helpful in developing a constructive working relationship. This entails maintaining independence and objectivity, and also in fulfilling my responsibility to oversee financial reporting process, because ultimately my whole audit is dovetailed to one thing, if I may want to put it as one thing, is reducing the risk of material misstatement. क्या मेरे financial accounts, right from the trial balance to the P&L account and balance sheet, what are the areas where there could be some wrong reporting or misreporting, intentionally, unintentionally? I have to continuously be very vigilant of that. Moreover, we have to obtain information relevant to the audit as to how the audit is to start, its planning process, the scoping, the timelines, etc. All that is part of my objective of having this communication. So just to reiterate, my responsibility to overview of planned scope and timing of the audit, and also obtaining information from those charged with governance, and also timely observation of any significant and relevant issues which I may have come across during my audit process and not waiting for the end of the cycle of my audit. So this kind of an atmosphere of communication, if the tone at the top is set right at the beginning, in fact, the planning document of how I will assess the risks and dovetail my audit program as to my sample size and to the areas of what I need to emphasize, whether it is sales, purchases, procurement, inventory, work in progress, infrastructure work, fixed assets, liabilities, borrowings. What is my thrust area for each audit based on my past year's experience, or seeing the industry in which the company operates, or the balance sheet and the P&L and the geographical spread, or the multiplicity of other aspects which may be required to having a separate focus on planning. When I have established these objectives, so I have to define who are those charged with governance. It is a new term for many auditors over the years. This standard came in 2017, but over a journey of an auditor, it is relatively new, and I have to distinguish with the management. Sometimes in smaller organizations or the way structures are there, it may include management personnel. Because then only I will be able to start complying with the responsibilities which may have been put on me under this SA 260. Similarly, the management has to be in executive responsibility. They have to define somebody who will be actually a single point contact, maybe a cluster of a subgroup, which will be part of the total, those charged with governance. I have to, what are my key requirements? Determine the appropriate persons. Once I have done that, if it is a subgroup, then I need to also determine any communication with the governing body also. So I may communicate some of the highlights to the governing body or the audit committee, etc., and have detailed discussions with the subgroup. And if it is a single owner company or a manager company, then there is no need to communicate once again, because there I am in touch with the management on a day-to-day basis. But my documentation, my oral communication has to be minuted. There is a process defined in this essay to be able to comply with that. Coming to the key matters, I have to look into this. We have to fulfill a major responsibility of expressing an opinion on financial statements which are prepared by the management. It does not relieve the management and those charged with governance of their responsibility. So this is the primary underlying factor. Sorry. As I mentioned, the first thing is I have to plan the scope and timing of the audit. If I have identified any risks, I must immediately inform those charged with governance about those risks which I need to deep dive. I cannot, that I'll be failing in responsibility if I don't do that. Similarly, significant findings during my audit have also to be communicated with them. This actually includes qualitative aspects also, apart from quantitative issues of entries, etc. Moreover, there may be significant difficulties encountered. Most of the time, the ERP access is not there. The SAP node is not given, and we have to just rely on data from printouts or Excel formats, etc. So we don't get access to the system, which is a major limitation. And now doing an IT assessment both on the application side and as well as the governance side, this is a key requirement for me to see that the built up of information which will lead to the balance sheet and P&L account is robust. The controls are there. No manual intervention is possible. There is an audit trail, etc., etc. And ultimately, are there going to be any circumstances which will affect the contents of my report? I'll have to be very vigilant that as soon as I come to know of something which will be requiring some mention in my report, qualification or otherwise, I need to bring it to the notice of the management. We already talked about the independence. I have to make a separate assertion to the management that the engagement team, others in the firm, the network firm, if there is any, and have to comply with all the ethical requirements and all the requirements of independence of the Companies Act, and any relationship with other matters between the firm and the entity, any professional work I'm doing, which can have a bearing on the professional judgment and on the independence ultimately, whether any safeguards are required for any self-threats or any other perceived threats, all have to be brought down in writing and separately communicated with those charged with governance. Typically, as I already mentioned, if the auditor is making some oral communication, it's not adequate. I'll have to record the minutes of those oral communication for my working paper and also share a copy of that with the management so that there's no misunderstanding or different interpretations. Similarly, the whole process has to be done on a timely basis. I cannot, close the audit and then start communicating about issues which I have faced or any issues which I want to raise in my audit report. That has to be done well in time. It brings trust, it brings transparency, it brings also a feeling of that I'm auditing. I'm not going to be fault finding. If there are issues, most of them, they could be resolved. So I must give an opportunity for the management to resolve those issues by passing rectification entries or taking third-party opinions or valuations, etc., so that in the end, the results are as pure as possible. That is the overall objective. And then I have to make sure you are in line with what the reporting is there. Again, I mentioned when and where the matters were communicated, documentation, minutes, all that has to be there. In fact, when we go through some of the NAFRA reports, we find that there has been a serious non-compliance reported in SA 260, and the defense of the auditors saying that no, we discussed every day with the management, and sometimes it's oral, sometimes it's informal. And anyway, I'm making a presentation to the audit committee or the board, whether it is quarterly, half-yearly, or the annual. NAFRA was clear that it is still complete non-compliance of SA 260. There has to be the planning document. There has to be a formal communication on independence and so many other matters which may not come up in the audit committee presentations. And oral communication, not acceptable. Documentation is required. Minutes have to be there. A trail of such communication is required. So there was, in many cases, such kind of strictures which have been passed against some of our brothers. So we must understand that basically there has to be something more than informal discussions, etc. Basically, the whole idea is that right from day one, the management and us are on the same wavelength, and there is no ambiguity in the whole audit process. the communication is one thing which is just part of an audit. It does not relieve us of our responsibilities to actually carry out and comply with the accounting standards, auditing standards, etc. SA specifies specific, there are actually procedures. There is not to carry any specific procedure for this. This is just an ingrained activity, and there's no SA that something else extra needs to be done. And there could be some restrictions or laws on in this communication. I may have to be seized off. And the role of the management is distinct and common in some cases. So that also I have to be well aware of. That management and those charged with governance are largely different in larger or medium organization, but there can be an overlap. There are several references in essays and our SQC1, which needs to be also kept in mind when I'm looking at communication. And in fact, para 42 of SQC1 is specific, where it talks of that I have to identify and the role of the engagement partner. Who will be the engagement partner? Who will be the quality review partner has to be communicated to the key members of the client management as well as those charged with governance. I'll have to make that assertion right at the beginning of the audit. Similarly, SA 240, which is we are going to talk about, my colleague Ashish is going to mention that, on frauds and how that have to be linked to my communication with those charged with governance. SA 250, this is again our Learned Council member, C. Ranjit mentioned that if there are any violations of laws and regulations, how I have to define my responsibility. I just have to brush it under the carpet or make a hue and cry of it. What is the balance required? How much it affects my audit? How much it affects and leads to any material misstatement? How much it is pervasive so that it requires more disclosures, or something which is not as minor, not as major, but minor, but still it needs communication with those charged with governance, is covered in SA 250. And SA 450, evaluation of misstatements. So many misstatements normally come up during the audit. Some may be corrected, some may remain uncorrected because of materiality thresholds, etc. So I have to be cognizant of that. My essay is very well giving me a lot of indication, a clear-cut roadmap of how I have to deal with these, whether it is a control issue, whether it is an intentional issue, whether it is a people error, or something else which because of a new law, the application could not happen, or the estimates of probably the actuary or the valuation expert, etc., went haywire. Something was a legacy issue or something because of change of incumbency of the CFO, etc., or migration to a new accounting system, or opening a new line of business. It could be anything. But because of what is the root cause of that will also help me increase my audit scope or dovetail it to ensure that the audits are, the financial statements are actually free from complete misstatements when I present it to the stakeholders. Similarly, SA 505, external confirmations, whether there is any impediment, what is the process, whether it is vendors, banks, we have, what is the process, how early I have to do it in the audit, the way the results have to come to me directly, whether management help is required or not, whether screenshots on the web pages of the banks are sufficient, etc. All that is relevant for my communication on this part, because if something is amiss, I'll have to communicate with the management. SA 550, related party, we're going to talk about it. And also, if there are key audit matters which I'm wanting to bring it to the attention in my audit report, that also has to be separately communicated with those charged with governance. And of course, ultimately, if there are emphasis matters and other matters or any qualification, disclaimers, etc., well in time, I have to make that mention to the management as well as those charged with governance. So it is a major responsibility, but luckily it is not very difficult. If I understand from the word go that this is an integral part of my audit team's training, the consciousness that my audit process documentation is going to be linked to this in a significant manner will help me result in an effective and letter and spirit compliance of SA 260. Some key pointers, my friends. The responsibility for communicating is with the auditor? No. Even the management is also to communicate, and they have a responsibility. Suppose there is a suspected fraud or an actual fraud, or is there something which they want us to share about their business, any governance issue which they have faced during the period of the audit, or any further developments in their business or in their company, they also are obliged to address. And I have to make them understand that this is their responsibility from day one. So also communicating with the subgroup, I'll have to give the gist to the governing body so that nothing is out of their radar. Smaller entities I mentioned, even one person can be in charge of governance. So there is no way that I feel that, that is the biggest trap, that my communication with even that one person will have to be in a formal, structured, and complete compliance of SA 260. And of course, in case of complex potential conflicts between my obligation of confidentiality or any other obligation, whether I need to seek any legal advice or written representation, that also becomes my obligation, my friends. So this is basically on this. I'm not getting into detail because, time is of a sense and we have to carry out another essay covering. I'll have to, oh, sorry. Can you hear me?
Yes, sir. We can hear you.
So I'll stop sharing my screen. I'll now have to go to the other. How are we for time, Anilji?
Sir, we have 20 minutes, 20 minutes, sir.
Okay, fine. So the related party is quite a complex thing. And if we are looking at LODR, that's another full 2-hour session. So I'm not going to get into that because then we will not be able to do justice. But I'm going to stick to SA 550. And basically here, financial reporting framework. I hope you can see my screen, Anilji.
It's visible, sir. Please go ahead.
Okay, so basically AS 18, Ind AS 27, section basically 188 of the Companies Act is very important because that deals with related party transactions. I have to be very cognizant of that. Similarly, the definition of related party under the Companies Act, that's also very critical, which is subsection 76 of section 2 of the Companies Act. Then the SA 550, how that, so basically the whole ecosystem of related party transactions are relevant for establishing and complying with SA 550. Basically, where minimal or no related party requirements are there, I have to see who is having an effective or significant control and whether another entity over which I have a control or entities under common control. So the complex webs of companies also come into play, making the whole situation very murky at times. And it could be a way the businesses are structured, or it could be a device to kind of, manage certain things in a certain manner, or because of the complexities of businesses or different nature of that business, I have had to go into that story altogether of complexities. What is the need and scope of the standard? Typically, it deals with my responsibility as an auditor and what are the regarding related party relationship transactions while performing my audit. And specifically, it expands how the following essays are to be applied, because there are 3 more essays which have to be kept in mind while I comply with this SA 550. One is SA 315, which talks of identifying and assessing the risk of material misstatement. I touched upon it in the earlier presentation. And SA 330, what is the design and implementing, what is my response to assess risks which I may have identified during my audit process. And also SA 240, which is again the auditor's responsibility towards fraud in the financial statement. So all these are relevant, and I have to keep this in perspective as I go along in complying with SA 550. Typically, what is my objective? I'll have to obtain sufficient audit evidence that all related party transactions have been identified. That is part one. They have been accounted for. So the entries have been passed, and then the disclosures. So one, of course, is I have to identify what are my related party transactions, whether they have accounted for, and then, of course, talk about taking them for disclosures. For that, I have to perform detailed audit procedures to identify, assess, and response to these risk of material misstatement, recognition of fraud risk factors, and also to conclude that the financial statements are fairly presented and not misleading. And of course, for all this, I'll have to rely to a certain extent with my checks and audit procedures on written representations from the management. So all this is a very detailed exercises, and depending on the complexities of the organization, I'll have to keep that into perspective. Typically, when I do a risk assessment procedure, I must realize that the entity's related party relationship and transactions, we have to inquire from the management and whether the management has established controls. So what is practically happening? I may enter into related party transactions, and as rightly pointed out by my learned senior council member, C.A. Ranjit, that these related party are not something which should be worried about, as long as there are established controls to see that they have arm length is established, they are there in the normal course of business, and essential for what is the transactions which are being recorded in the books of accounts. Anything which is amiss, then my radar has to be more focused, and then my whole audit procedure changes accordingly. As I already mentioned, SA 315 is basically the risk of material misstatements, which I'll have to keep into cognizance. These risk of material misstatement prompts me to maintain alertness. The skepticism is very, very important. For related party information, when I review any documents and information indicating existence of related party or transactions not previously identified or disclosed, this is the biggest red flag, my friends. Basically, I'll have to be very, very vigilant on how I'm able to, during my audit procedures, if I identify anything which has not been recorded. So what, according to SA, I'm going to just read one of the paragraphs, which is, I thought it will be pertinent to read that from the SA itself, where it talks of the paragraph 15 of SA is very important, where the auditor shall inspect in the fall and the indication that these transactions are not previously identified. Then I'll have to look for bank and legal and third-party confirmations obtained as auditor's procedure. How I will find out is given in this essay. Secondly, I have to see minutes of the meetings of stakeholders as well as those charged with governance, and also any such other record or document which I as an auditor may feel necessary in the circumstances. Because without that, it's impossible to try and deep dive and try and identify what is relevant in terms of how to make it possible to see. In paragraph 22, there is another significant aspect which I'm going to mention. If I find such transactions, then I shall promptly communicate the relevant information to the other members of the engagement team. So all my team has to be sensitized. I cannot leave it to the dealing person who is actually finding these items not disclosed. Then wherever applicable, I'll have to request the management to identify all such transactions with the newly identified related parties. So if I find there is one related party which has not been brought out, whatever the reason might be, I'll have to go into them separately, whether it was by mistake or by intention, but I'll have to make a formal request to the management that please let us know in writing what are the transactions with this related party which was not hitherto captured by you. And also, then most important, inquire as to why the entities controls over related party transactions, and they fail to enable us to identify or disclose such transactions or relationship. This is very important. And accordingly, then I'll have to perform appropriate substantive audit procedures. I'll have to extend my audit procedures relating to such related parties and the transactions purported to be entertained or entered with them. And of course, ultimately, all this boils down to reassessing and reconsidering the risk that other related parties or significant related party transactions, both some other related parties or some more transactions may exist that the management has not previously identified or disclosed. And of course, the intention behind it. So this is something very important, friends. You need to be very vigilant. Similarly, point number 3, if there are transactions which are outside the entity's normal course, then again, I'll have to follow procedures which are very relevant, very much different from a normal audit procedures. I'll have to identify whether there is any business rationale or lack of thereof, for example, for these transactions, which may suggest that there is any fraud or purported fraud which may have been existing to enter into these transactions which are not in normal course. Similarly, what are the terms of these transactions? What is the explanation of the management? And is there any precedence, or this is one-off situation? Again, that will also have a bearing on my overall assessment of how to consider these out of the normal transactions. And similarly, what are the disclosures? Have they been appropriately accounted for? One, of course, and the disclosures are adequate. Whether they have been authorized properly, whether the chain of command and the delegation of authority is being followed in these transactions, and those charged with governance have been fully appraised of these, or it is just the prerogative of the management at the lower level where such transactions have happened. So all that is also very much important. These two aspects are very important. This is an important slide, my friend. Similarly, risk of identifying any fraud risk factors. What are the domination of management of one person? If one person is, the culture of the organization is very important, even though there may be an audit committee, a board, CFO, CEO, etc. But if one person is, one or two or a small cluster of persons are kind of controlling and keeping information, and nothing flows to the auditors without his agreement, etc., then my fraud risk assessment increases. I'll have to also find out the dominant influence through various aspects: veto power, control of financial approval, everything, check signing authority, etc. Any unquestioned decisions which are made unilaterally and then somehow recorded later on in the minutes, and approval of transactions without review, whether there's a checker and a maker process, or a 4I principle, or it is just very limited way of these transactions. So friends, basically the key thing is, who are the related party, what are the transactions which have been entered into, and how they have been recorded in my books, and also how they have been disclosed. Now, coming back, whether these are transactions which are not in the ordinary course of business, or there are any related parties which have not been identified, then my procedure increases significantly. These standards have been there for long, and as we go along, they have been made more and more stringent. And if we look at some of the LODR requirements of the latest SEBI amendments from 1st April 2022, which we are being signing now and over the next few months, and also from 1st April 2023, which have made them more onerous for those companies which are listed, etc. I find there are significant issues which need further deliberation. And my friends, the difficulty is that the Companies Act and what the LODR is, they are not talking to each other very well. There are conflicting views. There are, something prior approval of even small transactions, any significant variation, again, prior approval, not only of the audit committee, of the shareholders, making the whole exercise very onerous, cumbersome, but nevertheless mandated by law. So basically, this is all I have on the related party. I have restricted purely on the SA, not gone into the LODR requirement, because there the complications multiply, and I will not be doing justice to this time and to my brothers and sisters in getting into that. Typically, problems would arise of, I'm just going to give you small hints of institutional investors, persons who are holding shares through different entities or Benami entities, how the declarations will be available on these aspects, and how does the audit committee know the purpose and the effect, how they are able to determine this aspect also needs to be kept in mind, because the terms are so wide. And the subsidiary companies, the web of holding companies, if I am to support my subsidiary company with finance or some transactions, if it is a new company, definitely the holding company will have to interact. Their prior approvals, etc., or serious modifications with the terms have to be envisaged right at the beginning of the year, if not even before the start of the year, so that I'm able to comply both in letter and spirit. Similarly, if there are any urgent requirements, how I'll have to deal with that again comes into play as I go along in complying with the standards. So friends, I'm parking myself here for the moment, pausing, and I'm requesting my learned colleague to take over. But thank you very much for giving this opportunity. Deeply obliged to the Institute as well as the AASB, under the aegis of which these series are coming up. I'm very happy that these are being planned across different essays and different key requirements during the in the audit season. Like we are in the mango season, this is the audit season, and as we go along, we will be keep reinventing ourselves and all back to school in terms of what is vigilant audit. We don't want to make it an overkill and scare my brothers, but definitely the skepticism and the level of skepticism has to be of very high order, and the alertness also has to be very much focused. The key thing, friend, is to get into a training with your junior most employees right before the audit. So you should get into a huddle before the audit teams are sent, even though sometimes it is a firefighting, some bank audits have to start, other audits have to start. But please have this huddle meeting with each of your audit team members, right from the partner, the quality review partner, so that they are on the same wavelength. If something is amiss, immediately there is a turnaround time which is shortened, so that we don't come to these difficulties at the fag end of the audit. Then neither we are in a position to communicate to the management, to ask them to respond. Neither we are able to provide solutions and samadhan, where in many cases we are able to do that. And also then we are kind of in a conflict as to qualifications, emphasis of matter, etc., etc. And that has to be avoided. Ultimately, as globally, no qualification is accepted in the US PCOB. Basically, you have to make adjustments. There is no such thing as qualifications there. And Sanjeev will also bear with me in that basically I'll have to make those adjustments irrespective. Otherwise, it's going to be a major challenge closing the accounts. So thank you once again, gentlemen. I'm going to stop my screen share. And at this
Thank you so much, sir. So can you hear me, sir?
I can, Anilji.
Thank you so much, sir, for such a wonderful deliberation on both the essays. Sir, we are having 2-3 questions for you. If you allow, may I?
Please go ahead, Anilji.
Yes, sir. So there is a question, one member is asking, is it mandatory to check if the transaction is at arm length for each related party transaction?
Yes, though materiality will always be there, but definitely
Yes.
arm lengths will have to be established. Because actually, I just want to add, transactions with related party is not a bad thing. But is there any ulterior motive? And that can be easily established when arm length is established. Now, sometimes there is no precedence of arm length. That is the problem. When I'm supporting my subsidiary or there are some unusual transactions, sometimes transactions are without any journal entry also. If I'm allowing them for use of space, or if there is some other, concessions I've given, they're multifarious. The startups have so many companies. Each large company has hundreds of subsidiaries. All that is a mumbo jumbo. So arm length is basically a common sense point of view. I'll have to do a lot of research if there is no precedence available within the organization, within the industry. I may have to take expert opinion. I'll have to rely on my quality control partner and my seniors in the profession to deal with very peculiar circumstances. But in nutshell, arm length is critical, sir.
Sir, whether procurement from related parties without inviting competitive offer can be treated against arm length price?
If you want, the first answer is yes. Because why I have not asked for other vendors to supply? If that has to be established, because prima facie, then my risk increases significantly. Then I have to go into deep to see whether this is a monopoly supplier which is only doing OEM to me as suppose I'm an auto ancillary, a subsidiary or an associate company only supplying to a parent company, and they have no other orders, etc. Then I have to see the margins, because ultimately arm length in international transactions and domestic transfer pricing is already embedded in the income tax. That gives me a lot of guidance. 48.2 and all those transactions, what are the margins, and the way I have to establish related party arm lengths through those international or domestic related party transactions provide me a very big tool to actually carry out this exercise. So please go and re-educate ourselves on the various methods internationally accepted under OECD model or otherwise established under Indian Income Tax Act. Every day there is a new judgment right up to Supreme Court of what should be a best method to determine arm's length price when I don't have quotations, when I don't have comparables available to me.
Ji, sir. So last question. In case of listed company, communication is generally made to audit committee as a subgroup. Does SA 260 requires auditor to communicate? Same with board also, which is the governing body?
I've already touched upon that. So the subgroup is the audit committee. I have to have detailed discussions with them. I have to have independent discussions with them without the management. And that is also mandatory. And they do engage separately because then the confidentiality and ease of exchange of information is there. But definitely in the board, if there's something which requires, and if there are any qualifications or any difficulties are encountered in getting information, or any other significant aspect which affects the accounts, or which has led to some material misstatement or any control weaknesses, I am duty bound to bring them to the notice to the board as well. Not in all cases, but definitely in exceptional cases. And
Fine,
also,
sir.
I must ensure that my presentations are available to all the board members, because then they can independently discuss, see those presentations, and if they want to reach out to me or to the audit chair, etc., they can do that. In fact, the audit chair would ultimately present these accounts and my discussions with them to the board. So primarily they kind of take over as the link. But if there is something not 100% okay, then I think there is an obligation to reach to them as well.
Thank you so much, sir. It was wonderful and nicely explained. On behalf of AASB of ICI, I extend my heartiest thanks for sparing your valuable time and acceding to our request on a very shorter notice and enlightening all of us on various intricacies on both the essays. Thank you so much, sir. Thank you so much.
Thank you. And if there are any other queries, anytime you can reach out to me. And
sure, sir. Sure. I'll forward it to you through mail, sir.
Thank you very much.
Thank you so much, sir. Thank you, sir. Thank you. So moving on to our next technical session, we are having with us C. Ashish Gupta ji to take a very important essay, essay 240, that is relating to the auditor's responsibility relating to fraud in the financial statements. So it is another very important topic in these times relating to the audit. So we are having with us, without wasting much more time, I request Ashish ji to please deliberate on your topic. Over to Ashish ji, please.
Thank you, sir. And it's always, as I said, a privilege to have somebody like C.S. Manji precede my session, because half of my job has actually been done already by Sumanji. So what I'm going to do is essentially through the next 45 to 50 minutes, because we're going to leave about 10 minutes for question and answer, is to cover some of the practical aspects that I personally have faced in my tenure as auditor over the last 22 years in the profession now in practice, and also then have some kind of a, I would say, discussion with the members in practice who are attending this webinar. And so therefore, please do post your questions. A lot more questions, are most welcome, because that's where we, clarify some of these areas. As Sumanji, rightly mentioned at the start of it, all these standards are interlinked eventually. Whether you look at SA 550, whether you look at SA 260, I mean, all of this is really genesis of that is coming from the framework of the auditing standards, right? And that framework of the auditing standards eventually is based on the fact that as an auditor, my responsibility is to opine on the financial statements, whether the financial statements are free from any material misstatements, and therefore they're not hiding any material misstatement of occurred due to either an error or a fraud. I think Sanjeev ji also at the start of it mentioned about this expectation gap, and when I really set up this session, SA 240, and discussions about the practical sort of experiences that I've gone through and how I've really navigated those complexities or those situations that I went through, particularly around SA 240. There is a huge expectation gap, and that context needs to be understood by each one of us attending here. Today, when we go and talk to even the audit committee, through an SA 260, I think even though the primary responsibility of designing and implementing internal controls lies with both the management and those charged with governance, eventually a question is asked of us as auditors that, please tell us if you've come across any instance of fraud. Please tell us that, you've designed appropriate audit procedures, you've gathered sufficient evidences so as to confirm that the financial statements are free from any material misstatements either due to error or fraud. This expectation does not only end with our audit committee communication, but please understand that the way regulatory framework is evolving, maybe in the right manner, eventually that framework is pushing us in that direction that we have to exercise absolute professional skepticism throughout the engagement and use most of our experiences. And as Sumanji also said, through dialogue, through communication, both within the engagement team, with the management, with those charged with governance. Because please understand that regulatory environment is always applied in hindsight, always applied in hindsight. Whereas as an auditor, you are looking at the information in a more current manner. While you're obviously looking at transactions that have expired, but at the end of the day, the benefit of hindsight is not the way you possibly have when the regulators come and review your audit files. They're going to ask you questions with information that has evolved much ahead of time, which could possibly be looked at by us if we had done our procedures appropriately. So we as auditors are expected to have some foresight so as to address their issue of hindsight. So now with that context, I'm going to start sharing my screen and lay out what I'm going to do. Is my screen visible to all?
Yes, sir.
Okay, I'll just
make it full screen, sir.
Yes.
F5. Yes, fine, sir.
Fine. Okay.
Yes, sir.
So I said, I think it's important to understand, what is it that we are going to learn, or let's say, or share the experience over the next 45 minutes. The first really is that there is a big question that I'm sure a lot of you would have had. I at least had when I was starting my career in the audit. That are the auditors supposed to uncover all frauds? Are we supposed to be the gatekeepers for the shareholders to say that there is no fraud that has happened in the company, is likely to happen in the company that we are auditing? What is the expectation that users have when they read our audit report? So when you go and talk to, as I was giving an example, one is the regulator aspect of it, the other is the investors. Off and on, we are seeing that there is an increased activity by both the institutional investors, private equity, and so on and so forth. They are expecting a lot more from us. And I think there is that expectation is very crossed. I would say some principles, broad principles that the auditing standards today have, where they are actually asking and questioning us as auditors to say that, can we be the mechanism to detect and report frauds? Now, I think that is a very, very significant expectation that the users of our audit report eventually have from us. The third aspect that, is relevant from our role perspective is what should be our response in a situation. Suppose we come across a scenario where there is a fraud or a suspected fraud. There is a suspicion that we have basis the procedures we would have performed, or information that is known to us that there is potentially a fraud. So what should we do? So these are the three aspects that we will obviously cover through our discussion today. The other aspect, we're going to also touch upon, and again, Sanjeev ji, Ranjit ji, and C. Suman ji also mentioned about this big reporting requirement now under CARO 2020, especially around whistleblower mechanisms. And a lot of companies in the country do not implement or have not implemented or in the process of implementation of this whistleblower mechanisms, right? Therefore, it is very important that we understand the dynamics of how this CARO 2020 really reporting look like. How does our work under 240, 315, 330, designing through 40, and then evidence gathering through 500, so on and so forth, really all come together to have reporting under CARO 2020. Then I'm going to also share some of the experiences on 143.12 and how is it subtly different from what we call it as our responsibilities from a fraud reporting standpoint. Let me begin with warming up, right? I mean, I think what I'm going to do is just share 4 scenarios to give you a context of what this SA 240 and what the standard eventually entail for us. Why is it so relevant? Why is it so important? So let me give you an example. A company is in a diversified business scenario. It has got multiple channels of distribution, typical FMCG, for instance, or any commodity which is driven through layered distribution channel. There, we've been auditing and we noticed that there is the internal controls are not so elaborately designed or implemented, or both, right? We also noticed that because there is a layered distribution channel, diversified distribution channel, there are certain payments that are made through the channel for promotion of sales. There are a lot of credit note activity that is inherent into the business, or the way revenue is earned by the company. Now the question really is that how would you address this situation? Would you just say that okay, fine, this is a diversified business, fine, there are different channels. Let me do one thing. Let me test all the credit notes that are that have been recorded by the company. Let me look at all the payments that have been recorded. Quite frankly, that's not practically possible. You can't really look at it. So therefore, what is important here is that the manner the business is set up by the company, the manner the business is conducted by the company, the manner there are different channels being involved, there is a high probability and propensity of a fraud being committed by somebody in the company, right? Either at a operational level or even at a management level. So therefore, understanding of the operations of the company, the diversity of its business, how the business is conducted, what are the particular business activity is absolutely paramount in determining how would you take this from a fraud risk perspective. Prima facie, all the 3 angles of a diversified distribution, payments being made, insufficient internal control, design, implementation, or both, strongly indicates that there is a significant risk of a misstatement in financial statements due to fraud beyond just the error. So that's just the one practical scenario. Let's say there has also been frequent changes in the CXO level. Suddenly you come across that CFO just tenured only 5 months, another CFO came in, tenured only 1 month, then there was a CEO change, and so on and so forth. How do you really consider that from an auditing standpoint? You obviously factor this in the 315, no doubt, because this does increase risk of material misstatement, because the supervision by itself is subordinated and discounted. So, but is that all? The answer is that whenever you have such situations, please pick up these signs. Frequent changes in CXO level or the board level indicate that there's something wrong within the organization. And that needs to be factored in while we are doing our determination and saying that, is there a significant risk of a material misstatement in the financial statements due to fraud? Yes, these signs do indicate that. I'm not saying that there will be a fraud, but there is a significant risk at the entity level, at the financial statement level, because of these changes. Let's say another scenario: a shareholder of a company sends a letter to you as an auditor, saying that there are allegations being made that there is a gross misconduct of operations, there is operation mismanagement, blah blah blah, and therefore you as an auditor, please be aware, make yourself aware of some of these things. But that letter does not give any specifics. It is a very broad question. Is how do you respond to that scenario? Again, the point here is that whenever you look at and doing an audit, conducting an audit, when you do a risk assessment, when you do a responding to that risk, you cannot just be looking at information that is within the organization. You have to look at information that is outside of the organization as well. So therefore, do not close yourself to saying, okay, I've obtained information from management, I've obtained a trial balance, I've spoken to the business heads, I've spoken to the CEO to understand the entity and its environment, and that's good enough. The entity's environment does not sit within the entity. It sits both inside and outside of the entity. So therefore, please be conscious of this fact that whenever you look at designing any audit procedures, specifically from a fraud risk standpoint, some of this communication should raise an alarm bell, saying that, okay, while understand this is broad allegations, but help me understand this. Either this is at a financial statement or an assertion level. Let's say there is also a company that has significant transactions with entities that are pertaining to or relating to the promoters of the company. Again, Sumanji did touch upon that fact that how do you address a related party transaction? But again, the question is that whenever you have significant transactions with related parties, and those transactions are pervasive in terms of the their levels across the financial statements, and or quantity wise, quantum wise, how do you really, again, this should just flag an alarm bell in your head to say that, okay, yes, I as an auditor, again, cannot be ignorant of the fact that these are just normal transactions. Yes, they may eventually be, but I need to ensure that I have factored that these transactions, the relevance of these transactions, the fact that these transactions are with related parties when I'm determining my risk assessment of the 315 while considering under 240 as well. So just to give you, a framework of, different scenarios, because all of these scenarios we face as auditors when we, conduct our audits in the normal course of our engagement as auditors. But again, does it mean that we have to do everything? Ultimately, as the expectation some investors would have, that we are the gatekeepers for them. We will. It's our responsibility to prevent, detect, and at times report the fraud. And the answer is, legally it's not, because eventually it's the management's responsibility to establishing internal controls over the preparation of financial statements, so as to ensure that the financial statements so prepared are free of material misstatements, either due to fraud or error. It does not take away, our work is not by any way substituting the management's responsibility or the responsibility of those charged with governance. We've come across, at least I've come across, a situation where at times, some of the members in practice miss this responsibility, defining this responsibility in both the engagement letter and the representation letter. Therefore, please do consider this aspect, that it is eventually the responsibility of the management first to design and implement internal controls so as to ensure that the financial statements do not contain any material error, either unintentionally or intentionally. That is fraud. What is our responsibility? I mean, our responsibility is, as I said, in terms of the SA 240 clearly cast in stone, is to identify and assess wherever there are potential risks of misstatements due to fraud. That is the first thing, which is identification of those. And some of the scenarios that I've given you are indicators that will help you identify. And in the discussion, we're going to give you some more practical insights of how to do that. Second is that when you're designing your audit responses under SA 330, you're obtaining sufficient and appropriate evidence. Means that first of all, you need to make sure that the design of your audit procedures are in a manner that you're eventually obtaining sufficient and appropriate audit evidence so as to address those risks of material misstatement. So simple example, as in the previous slide, I talked about related party transactions, significance of related party transactions, right? Now, should your audit procedures be only looking at what the transactions have already occurred and provided to you by the management? Quite frankly, the answer is no. In that case, the risk is not appropriately covered. The biggest risk when you have such a scenario is undetected, unreported related party transactions, right? So the risk actually that you have to address through a response is, what if there are related party transactions which are not reported to us by the management, which would eventually be not at arm's length and therefore would lead to material misstatement in the financial statements, both in terms of recognition, measurement, and even presentation disclosures. So therefore, it is important for you to identify what is the risk that you are addressing. The risk is not reporting of related party transactions only. The risk is, what if there are undetected material related party transactions, which would therefore result in misstatement in financial statements if not appropriately addressed by us. The third aspect is obviously respond appropriately in a scenario through an audit report, through multiple channels, like those charged with governance, should you come across a scenario of a fraud or a suspected fraud. So this is basically the broad responsibility that the SA 240 casts upon us: identification and assessing of the significant risks. Second, designing appropriate audit response and obtaining sufficient appropriate audit evidence. Third is, whenever we have come across, or we do come across a situation of a suspected fraud or fraud, how do we basically address that situation through a layered response. Let me also at this stage just pause and give you a little perspective of what are these fraud risks, right? I mean, how do you really look at a fraud risk? So again, taking an example, the company has bought a very large asset, right? It's a massive manufacturing plant with different manufacturing lines, this and that, and there is a transaction that the company has done to buy that asset for X amount, right? Now, one may say it's a very standard transaction. What are the fraud risks in this transaction, right? Whenever we assess fraud risk, we have to always look at this triangle. My suggestion would be just memorize this triangle, and this triangle, trust me, will help you a lot in rationalizing in your mind as to how you will address a particular situation. So taking my example of an acquisition of a large manufacturing unit by a company or a client of yours, what are the different fraud risks that exist? First of all, whenever you determine a fraud risk, you have to understand what is the incentive the management may have, or the pressure the management may have in eventually conducting a fraud or carrying out a fraud activity. So that incentive understanding will first give you that perspective, which will lead you to what are the opportunities that are built in to be able to carrying out that particular fraudulent activity. And then third element is that what are the ways that the management will actually, or who's conducting this fraudulent act, will actually rationalize this. Is there an opportunity? Is there a structure available to be able to rationalize that? So in our example, the fraud risk there would be if the transaction is with a related party, right? Then there is incentive that you would want to make sure that the company is actually paying the maximum value to the related party, right? So that's an incentive. Second is What is the opportunity in case there are internal controls which are not designed appropriately, or there is a promoter company where all decisions are taken by, say, that one single promoter with very limited oversight by the board, or there are very limited layers available within the company. That's an opportunity that overpriced. There could be a situation of an overprice that 100 rupees stuff is being bought over for 500 rupees, right? Because it's from a late party. Second is there is an opportunity of internal control. And the way rationalization could happen is that, you know what, this is one of its kind facility in the country. Nobody else has that, the kind of technology that, this particular plant brings in. We as auditors would be presumed that, we don't understand technology. So therefore, that will be a very simple rationalization that the management or somebody will give to us. So when you put this triangle, you understand that yes, there is a potential fraud risk of an overprice being paid to acquire this facility. There is an opportunity because of the structure the organization is, and also the rationalization could be because it's a very complex technology which we possibly do not understand, or there could be no alternative, let's say, comparables available for that. When you emphasize this, you will be in a position to respond to it through appropriate audit procedures. When you design your audit procedure, what those audit procedures would be, okay, hang on, let me understand what is the comparable that you've given, whether this is late party identified, not identified, whether those charged with governance reviewed this transaction or not, whether the comparables, in case comparables are not available, how was the price determined, either through an external validation of independent valuers, how those independent valuers were essentially engaged by the company, were they really independent or not. So some of these procedures that you will design to be able to address these fraud risks. So summarizing, whenever you look at any transaction, remember this triangle. That triangle will give you the steps that you have to follow in your mind. A, is there any incentive of the person or conducting that transaction to be able to conduct a fraudulent attack? Is there an opportunity the organization is given through an internal controls, weak internal control system, through a lack of segregation of duty or whatever? And is there a rationalization available that he can or she can tomorrow come and sort of give to us and saying that this is, by the way, overboard and not something which is suspicious. So therefore, this triangle is very, very important. Once you've determined this, risk assessment, as I said, through a combination of these transactions, either at the financial statement or assertion level, it is important that you follow this path, and this path essentially will eventually enable you to get to an answer that what are those specific risks, both at the financial statement level and at the assertion level, that could indicate a significant risk of fraud. First is you have to make an inquiry of the management, and that's when you call out management. Again, I'm going to give you some insight here. Management here does not mean CFO and CEO only. A lot of our teams often make that mistake that, okay, we've just asked the CFO simple 5-10 questions. How's the business? By the way, any unusual transaction, any change in organization, assuming that, he'll be faithful to us. He will give us all the response that we eventually, by the way, he's smarter enough to give the responses the way responses we want for our files. So he will give. Therefore, do not restrict yourself in making inquiries to CFOs only. Please identify a wider set of management, functional heads. Go and talk to the head of sales. Go and talk to head of procurement. Go and talk to head of compliance. Go and talk to head of legal. Understand from them how are they conducting their functions. What are the relevant controls they have built in? What are the risks they perceive? Ask those questions to a sales head. I typically do that. When I go to a sales head, I say, how do you ensure that people in your team are not pushing sales at the year end, because eventually their incentives are linked to the sales that you achieve in that particular reporting period. So how do you ensure that? And trust me, when you make those inquiries, you will get some of the insights that are going to eventually help you follow this path and get to the right answer of determining what are the relevance of fraud risks in the conduct of the audit. Second is, and again, something that most of the companies, discount a lot is the internal audit function. We as auditors need to question the adequacy and appropriateness of the internal audit function. There is a reason why this particular aspect has been reintroduced into Caro. This was taken off for some time, reintroduced, is because there is a huge relevance of internal audit function when you look at conduct of the business in the manner it should have been conducted in a as per the laws and regulations applicable to that company. So therefore, please do make inquiries of the internal auditors where they are externally, or internal audit function head where they are internally managed. Also, as Sumanji also mentioned, it's important to have that inquiry with those charged with governance at an appropriate time, not when the year has passed on, when you're closing the audit, but while you're planning the audit. Please have a discussion with either the audit committee chair, or if there's no audit committee, the chairman of the board, or where there is ethics committee, also with the ethics committee chair, to understand how are they discharging their obligations and responsibilities with respect to determining that they've designed appropriate internal control systems so as to avoid any error or any fraud. When I say error, any means material error or fraud. Once you've made these inquiries, it will give you a good understanding of entity and its environment, which will then help you go down to the next step, is observation and inspection. And that we typically call as walkthroughs. The observation inspection, by the way, is not just about internal controls only. It's about also determining relationships. So let's say we all know the raw material prices are increasing significantly for every company, right? Has that translated into increased provisions at the year end? So somebody comes back and says, "Oh, by the way, last year we made a provision for power and fuel for bills not received of 100 rupees, but whereas we know that the prices have gone up, so technically it should be more, right? If the manufacturing activity has practically remained the same or has increased." It's important that you establish these correlations, and that is the observation and inspection that you would carry out, not just looking at the internal controls, so what you've inquired, just observing and inspecting whether what they have talked about is appropriate and complete and accurate, but also making relationships. After you've done that, have an engagement team discussion. That engagement team discussion should not just be involving only accounting and auditing experts. It should basically involve a wider team. Involve direct tax people, involve indirect tax people, involve forensic people at times, if in case you have expertise in your firm, please do that. But at the bare minimum, involve every single engagement team member when you summarize your inquiries, observation, inspection, to discuss what are the things that will be relevant. What is it that you've learned through the first two procedures and steps? Then you get to, once you've gathered all of this, then you get to the fraud risk factors. That triangle, the triangle will then be applied both at the financial statement level and at the assertion level. Financial statement, I'll give you another example. The company is listed, the share price is fluctuating significantly up and down, and the management has very clearly said, "Oh, we're going to make X crores of profits by the end of the year." Right? There is a huge expectation management has already built upon itself. That is a fraud risk at the financial statement level, because that's not necessarily only confined to a particular assertion. That can be done throughout the financial statement level, whether it's revenue, costs, etc., etc. It's pervasive in nature. That's financial statement. Then assertion level, you determine what are the assertion levels. So again, I took the example of related party transactions. Say there are a lot of procurements that are happening with a particular related party, right? That again is addressed at the assertion level. Cutoff of revenue. What if the revenue is pushed into subsequent periods, or pulled from the subsequent periods into the reporting period? That's assertion level. When you test the occurrence of the revenue, that's where you essentially test that risk. So first you determine the financial statement, whether there is a management override of controls, blah, blah, blah. And then you drill it down to assertion level. What are those assertions at the financial statement that we've identified could be staring at a significant risk of material misstatement due to fraud? So that linkage needs to be established. And then eventually you conduct your audit and observe the procedures and the outcomes of those procedures. And I'll come to how you link it to 450 as well in the subsequent slides. Some of the things that you see on this slide are basically from my experiences of dealing with multiple companies and where there could be prevalence of risk factors which you should keep in mind. Again, something which I've talked about in the last 20 minutes or so. But again, do not confine yourself to only looking at information inwards. Please look at information outwards. Do not look at information that is otherwise you believe is not related to financial statements. Oh, what if there was that CFO just left? Now that's nothing to do with the financial statements per se, but that's a very important information. What if there is suddenly few people in the finance team, there is a sudden jump in the compensation. Now you may say, okay, just check whether the accrual is done appropriately or not. But hang on, is there something more to that increase or not? Is something that you have to be always have your professional skepticism up and running on that. When we talk about fraud, by the way, we do not only talk about that there'll just be embezzlement, somebody will take over the asset, deplete the value of the asset for his or her own benefit, which is called in a way taking away the assets of the company. But there's also fraudulent financial reporting. So it's both the risk of misappropriation of assets, which is that the bank account is wiped out, etc., etc. But there's also financial reporting. Typically, in our experience, it's a combination of both. Fraudulent financial reporting, essentially, you would typically end up seeing this done, and when you have a significant management override of controls, this is typically done or perpetrated at the senior most level, while the embezzlements and misappropriation of assets could be done at very operational level. So whenever you look at determining the risks, right, apply this thing of where there could be opportunities of fraudulent financial reporting, where there could be opportunities for misappropriation of assets. And then when you determine both of those, design the audit procedures accordingly, which could be, again, both at the financial statement level or at the assertion specific transaction level. Now, I did mention about the fact that the standard throughout, it's one thing which is very common across the entire auditing framework, and particularly so under SA 240, is this concept of professional skepticism. And I think Sumanji, everyone mentioned about this many a times. Professional skepticism is very individualistic. This is from my experience. You can sort of give tools, you can teach, you can train, but eventually it comes from an individual's understanding of a particular transaction, his or her commitment to doing the right thing, his or her commitment to enabling that they are conducting the audit as per the auditing standards. So it is very individualistic driven. I mean, how a person is able to think through. So therefore, this is something that, as I said, please keep that across. And I'll give you one solution mantra to do that. Whenever you conduct an audit, especially in a environment such as these, always over communicate within your team. Over communicate within your team. I'm using that word deliberately, or that phrase deliberately, over communication, because that's how you're going to eventually exercise professional skepticism on the ground. When you have 5 members of the team exchanging the outcome of the work, whatever they've heard, etc., on a daily basis, on a more frequent basis. You'll end up knowing information that will then help you in designing your audit procedures appropriately. That is one. Second is be cognizant of the nexus that the standards eventually have between them. These are not isolated standards. 315 is not isolated completely. A 240 is not isolated completely. They're all interlinked. It's important that you understand the interlinkages so as to apply a knowledge-based professional skepticism. So it's not just, oh, by the way, I believe there is an error here and I just go whole log just to only find out there is nothing there. Or I just completely ignore SA 320 materiality and just go everywhere and find myself that in the process of that, I've actually missed out a material transaction because I wasted a lot of time and energy in looking at immaterial items. So it's important that you understand that there is an interlinkage to all of these auditing standards. Understanding that interlinkage will enhance your professional skepticism and therefore help you deliver a better audit. Always look at, always question the reliability of the information. And, that's one thing that, one may say that, we're not the investigators. Are we, I mean, while there is again a debate now on whether, we are bloodhounds or not. But nevertheless, the point is that always question the reliability of the information that you've gathered through inquiries or which are not third-party sources. So bank confirm independently provided to you, will be much more reliable than a bank statement handover by the finance executive at the company, right? That reliability of information should be very carefully. So therefore, categorize your audit evidence in terms of their reliability. Wherever the reliability is slightly lower, just because of the inherent nature, if there's no third party available, like for example, technical assessment. Let's say a company is doing a useful life assessment. A useful life assessment typically is done by the technical department at the manufacturing plant who understand the manufacturing process deep in, deep out. And they will give you an assessment. Now that's an internal evidence. Please question the reliability of that. Don't just take them on face value, right? The other aspect is that whenever you determine any, the captions to do to apply an audit procedure on, please segregate, take out and put them on a different piece of paper. Things which are complex means that you possibly do not possess appropriate skills to do that. For example, the company is dealing with is a cement company. You have these huge stacks of inventory. Now we're not supposed to go there and understand the moisture behind that, and therefore the inventory valuation is appropriate or not. Gems, we don't understand what's the how's the quality of the diamond by ourselves. So please segregate all the areas where there is complexity, where there is a very high management judgment involved, where there is difficult to audit sort of transactions because it's based on something which is completely unknown, completely based on things which are, there is no comparable available. So difficult to audit transactions. Once you've segregated that, then you would know that what are the areas that you have to focus beyond just the routine transactions. These, I would say, are those non-routine things that you would have to look at with a very clever eyes to say that, okay, and as I said, over-communicate. Any evidence that you get in each of these aspects, question the reliability, look at contrary evidence, look at, different things that will lead you to, determining whether it's appropriate, or whether there is a significant risk or not, and whether that risk is mitigated or not. I'll just, in the interest of time, I've just talked about this I want to help you focus on some of the things again, some of the, things that I sort of focus on personally when I look at determining and categorizing in my head where, how to, approach an audit, how to identify significant risks of material misstatements due to fraud. I follow a simple equation, and please don't hold me. I'm sure there are mathematicians in this group who will possibly question me on the quant of this equation. But without going that, the principle is just follow these 5 points. First of all, what is the cap table? Whether the company is promoter managed or owned. Second, is it a diversified business or a very simple business? Buying, selling, purchasing, manufacturing, simple contract manufacturing, tolling. Whether it's a diversified or not. Second, third, related party transactions. Are there very significant related party transactions? More number of related party transactions, maybe of smaller values. So therefore, understand what the related party transactions are. How is the internal control? If there is a weak internal control, the risk grading has to be higher, right? So if there is a weak, and fifth most important is external debt. Whether there is an external debt involved or not. The external debt could be, a bank loan. It could be debentures being issued. It could be deposits being issued. Wherever there is a potential public money or money outside of the promoters being involved, yes or no. A combination of these five, if they are more than, say, a certain percentage, I say more than 50%, then you should assume that there is a very high grade of a management override, of potentially a control. And therefore, what you should do is identify, get down to assertion level and identify what are those assertions that could contain that significant risk that the financial statement could percolate down to that particular assertion. It could be a revenue occurrence, revenue being pushed in, pushed out. It could be a cost not accrued. It could be, as I said, valuations of inventory being very, very high. It could be, profit matching through, bogus journal entries, and so on and so forth. So therefore, please understand what are the financial statement through these five categories, and then drill it down to what assertions would that financial statement level risk will percolate down to. And accordingly, you will be able to design the appropriate audit procedures around this. Another aspect that we employ very carefully in this is testing of journal entries, and that's typically to address the financial statement risks where there is a very high potential of a management override of controls. This is not necessarily specific to an assertion, but this is more of at the financial statement overall level that there are no entries being recorded. So, for example, a company just records an entry, debit debit revenue, credit, or it basically a loan is evergreen. What if an advance actually a loan is shown as an advance? What if there are certain entries which are made to make sure that a particular cost number is subdued to that extent? So journal entry testing is a very important tool. How you conduct a journal entry testing is a specialized skill. There is a separate session. I'm sure the auditing standard board will consider, and my recommendation would be they should consider some of these very important aspects of auditing related party, auditing, through journal entry testing. These are specific areas which should be considered, but testing of journal entries is a very important procedure for us to determine if there are actually entries that are posted where there is a high probability of a management override of controls. Coming on, in the interest of time, I've got another 5 minutes. I'll touch upon the CARO and its relevance. As you all know, the CARO 2020 through clause 11 asks you to report on if there is a fraud that has been reported, noticed, or reported. And that fraud, again, is not confined, as Ranjit was correctly mentioning, that it is not confined to only, perpetrated by the officers or employees of the company, but anyone. Now, in this increased, enhanced cyber risk situation, please keep your eyes and ears open. This is a much expanded definition. So it's not only confined to the frauds perpetrated by officers, employees of the company. Anyone, a vendor sends a phishing email, a company executive, innocently or unknowingly responds to a phishing email, sends the wire out. That fraud is actually committed by a vendor on the company. Earlier, CARO did not have that reporting. Now it will be. What I'm saying is that when you are reporting on this, your audit procedures therefore need to factor that aspect. So, for example, please do ask questions which are outside in, not inside out, but outside in. What is the periphery of the environment that the company is operating? How are the customers that the company is dealing? Are there multiple customers? B2C, B2B, D2C, what are those customers? What are the vendors the company is dealing with? Whether those vendors are organized, not organized, etc., etc. What is the level of transaction? Is it through a paycheck? Is it through a draft? Is it through wires? How frequently are the systems and controls reviewed, monitored, amended, altered to ensure that there is no external intrusion of of anyone into the system, right? So please ask some of those specific questions, which again, all of this is written within SA 240. Just that Caro has just brought it up as a specific reporting on that. The second is on materiality. I think the concept of materiality very much exists. The guidance note on Caro 2020 underlines materiality of as an underlying principle. However, please understand your materiality and management's materiality will always be different. There are three different materialities. One materiality is what you determine under SA 320. There is one materiality that the board determines through their own checks and balances. They may determine it to be 5% of the revenue, 10% of the revenue, whereas it could be way above your materiality. So when you inquire a management or a board saying that, can you confirm that there is no material fraud? They'll say yes, there is no material, but from your perspective, there could be, right? So therefore, because the definition of materiality is different. Third is there is legal. So like, for example, under 143.12, if there is a fraud above 1 crore rupees, needs to be reported, right? Now that's a different materiality. Your materiality could be like 100 crores on an audit engagement. But if there is a company that, if there's a fraud being committed on the company and the company notices that and reports under 143.12, that also, by the way, needs to come out. Anyways, in the Caro, it's very specifically covered as well. One common thing that often people miss is this: they get confused as to under 143.12 who has got the primary responsibility to report. So 143.12 situation is not a situation where the management has identified a fraud. It is a situation where we as auditors have come across during the course of our audit. We've come across and we believe that reporting needs to be done. So therefore, please understand that 143.12 is not applied to a situation where management has identified, but where you identified as part of your audit procedures, and therefore it's relevant to be disclosed there. So that's another very important aspect. The other question which is very common is, how do you deal with matters which are still under investigation? Again, please understand, if they are investigation because you've come across something where you suspect a fraud and you've asked the management to carry out an investigation, it is a 143.12 item. And therefore, even when the matter is under investigation, it needs to be reported under 143.12 and then needs to be reported under Caro, and depending on the materiality, it needs to come on the main audit report. Besides that, obviously needs to alter. Your 315 gets triggered again, where suddenly your inherent risk, even if it was not elevated earlier, suddenly becomes elevated on related transactions which are under investigation. Where you've not identified, where the management has identified, please determine the stage at which the investigation, who's conducting the investigation, how are those charged with governance, either the board or the audit committee and or the ethics committee are involved. What is the potential implication of that matter should the investigation come up and result in an outcome which suggests that there is a fraud. Factor these 1, 2, 3, 4, 5 questions and then determine what is the reporting that you would have both in Caro and in the main audit report. Any matter of fraud, by the way, when noticed, cannot only confine yourself to Caro. You have to also look at how does it impact both your main audit report and your ICOFER audit report, your audit report on internal control. Because eventually, somewhere the internal controls did not work, and that's why there was possibly a fraud of a material magnitude, if at all. Summing up, another 2 minutes. I said always have professional skepticism while auditing financial statements. Have a wider team engagement. Over communicate throughout planning, execution, and conclusion. Please review all statements that you've identified during the course of your audit, which you say are not material. but they may indicate a fraud risk. They may indicate a situation which could lead to uncovering of a wider fraud. Always correlate with your internal control findings. When you do your test of controls for your ITO for reporting or even for understanding of the entity's environment, any finding that comes, for example, there is a weak IT system, for example, there is a lack of segregation of duty. Do not pass off lack of segregation duty just as saying that, okay, it's just a deficiency. Please understand how does that lack of segregation of duty eventually leads you to an assertion level risk to which that segregation of duty was supposed to address. Please review all regulatory submissions. As I said, information is never inwards, it is always outside in as well. So please do look at that. Current whistleblower process, as I said, there are a lot of companies who are in the process of establishing this whistleblower. So therefore, please look at where the whistleblower process is already established. Often you would find companies not really clear as to which way they would classify a complaint to be, as a fraud or as not a fraud. So therefore, they need to have a very clear mechanism of that whistleblower process where somebody in the board overseeing that. Last but not the least, as Sumanji mentioned, under SA 260, please involve audit committee, the board, the subcommittees at a right time. Do not wait that, only once I'm done with my work that I need to do an audit committee presentation that I'll tell them if there is any observation. Please involve them at a planning stage on a regular basis. Involve them whenever you hear any information, you come across any information that you believe requires a communication with the audit committee or the board or the subcommittee, as the case may be. And then be absolutely clear in your communication. Do not have anything verbal. Please document it. So that's something that will always remain. Something which is not documented is presumed to be not done. So please document whatever you're communicating. So that's all I have in terms of summing up my understanding of SA 240 and sharing some of my practical experiences. Any questions, I'll be more than happy to. Please ask as many questions as you can. I'll be more than happy to answer them.
Thank you so much, sir. For that was the wonderful deliberation. We have received so many questions relating to. Sir, can you hear me?
Yes, I can hear you. I can hear you.
Sir, there are certain questions for you. It was the wonderful deliberation. So first question is relating to this. Sir, can you elucidate and explain how these frauds noticed have been brought to the light in the Caro in case of some of the listed companies?
Well, I think there are many examples where frauds have been reported by by auditors when they've been noted. What is most important is how you keep your eyes and ears open to what is being noticed and reported. Please understand, it is not only reported, it is noticed as well, which means that you ought to have noticed that through the conduct of your audit procedures as well. Now, which means that please presume, first of all, whenever you sort of do that, first of all, never limit yourself to only 2 or 3 people within the organization, CFO or their finance function. Never do that. Have wider inquiries, and trust me, by just doing that one step, you will be in a position to identify a lot more information that will help you conclude on this aspect of that, was there any fraud noticed or reported to you? Because, quite frankly, you should presume that the finance team would try and hide information. It's always, I follow a principle that you should trust, but always verify. So expand your communication, inquiries, involve a wider team. Once you do that, just 2 basic steps and you'll see a difference in noticing that.
So what if auditor thinks that there is a possibility of fraud happened in the financial aspects, which are beyond the scope of audit work? What reporting he should do?
Okay, so let's say there is a potentially, when you look at it differently, whenever there is let's understand what is a fraud. A fraud is an act which essentially results in some form of misstatement. Now the question that could be is that what if there is a fraud, but that's not really material, right? Because ultimately our financial statements, our opinion is from a materiality perspective, right? We are saying that the financial statements are free from any material misstatement. So what if there is an employee claim that is not there, right? Now please understand that the scope of the audit essentially again is driven through a basic principle of materiality. We're not supposed to comment upon frauds which are not material. First of all, let me just be quite clear. One, however, suppose the board by itself decides that there are certain employee claims which are not material, but they are relevant to be brought to the notice of the board. I think it is an obligation, in my view, of the auditor to put it into the CARO. That's one. Second is always understand that you may think that a non-compliance of a law, where there is a wrong submission by the company which do not directly impact the financial statements, could that be looked at it? The answer is anything and everything that is connected eventually would have some linkage to the financial statements and the disclosures the company is carrying out. So therefore, please do watch out for, do not assume that, oh, it's a technical matter, I don't have to bother about it. What if the company has basically in a tender to a to a customer, they basically, and I'll give you a classic example of that. The company, while obtaining a tender, actually gave incorrect information and fraudulently so, intentionally, right? And you've come across that. Now you will say, how does it matter? The contract is already awarded, it's being service delivered, revenue is already accrued. But by the way, can you not look at the agreement that the customer would, the company would have had with the customer, where they would bound to be a situation where contractually the company is obligated in case it is found that the information that is submitted was misleading in nature. And what if there are, obligations, financial obligations cast on the company? Does not create a situation under Ind AS 37 by itself? Yes, it does, right? So therefore, please do not assume that something which is outside the scope of the so-called audit is not linked to the financial statements at all. Please have a look at it, and you can use this example that I gave.
So one member is asking about the NBFC. Please address internal auditors, that is the company employees, responsibilities relating to fraud in an audit of financial statements, and what care internal audit head need to be taken in NBFC.
Well, I think it's a very wide topic by itself.
Yes.
Internal audit, NBFCs, because NBFCs, you have to determine whether NBFC is deposit taking, non-deposit taking. Within deposit taking, is it peer-to-peer lending, or is it is it into a microfinancing? There are multiple models, so you have to understand the structure of the NBFC. When you have understood the structure of the NBFC, then you understand what controls the company has designed to circumvent the potential of a fraud within that structure. And then internal audit system needs to be thorough enough to be able to address those particular risks that are emanating from the very basic of it. Simple example, if it's a gold loan or if it's a microfinance situation. Microfinancing, you will have millions of customers of 100 rupees, 200 rupees, 500 rupees, very micro, very small ticket items. The propensity of fraud is very high. So therefore, your procedures will be designed very differently compared to it's an NBFC which only does B2B lending of multi-crores. So the difference is very need to be understood before I could respond to that specific question. But please understand the structure of the entity, and then apply your judgment around that.
Well, last question is, sir, regarding fraud by a company. CARO 2020 in one instance requires the verification of truth of QIS submitted to banks for the working capital finance availed in certain circumstances. Is it procedurally required to get certified copies of QIS from banks for commenting?
Well, I think any information that you get from the bank is a management information, right? A certified copy is that a management personnel in the bank will just certify and say that this information that he's providing is true and correct. At the end of the day, you have to also apply your judgment and your skepticism. Is as good as the information being given. It's just that he's signing it and giving it to you. How different is it from a management representation, or for that matter, any information that you would have sought in the normal course of business. So therefore, whenever you receive any information, certified, not certified by the management, is as good as a representation. Do not rely on representation blindly. As I said, reliability of information needs to be tested. So therefore, please do test that information independently as well.
So thank you so much, sir, for such a very, very explanative and very, very knowledgeable deliberation on the relating to the fraud and the relating to the financial statements. On behalf of AASP of ICI, once again, I extend my heartiest thanks towards you for sparing your valuable time and enlightening all our members and all of us through with your expertise. Thank you so much, sir. Thank you so much.
Thank you.
Thank you, sir. Thank you.
Record.